Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, and one of the co-founders of the Dividend Kings subscription service on the marketplace at Seeking Alpha. And this particular video is going to be rather short. I'm going to talk about what I consider to be the worst reason to sell a stock, but yet it's probably the most common reason why people do sell a stock. And that reason is if the price drops after you buy a stock, most people get mad or panic or get upset and they'll go ahead and they'll sell out their position. And my view is that just because a price drops got to be one of the worst reasons you could possibly have to sell a stock. In my previous video, I talked about all the reasons why you should or should sell a stock and also when you should sell a stock. So this is when you should not sell a stock. So I'm using the example. This is a real life example that I had experience with personally as a portfolio manager on a holding that we purchased for clients back in June of 2007. What I want you to see here is this is a growth stock. This was for our total return portfolios. This is not one of our dividend portfolios. And I want you to see that this company was growing at an unbelievable rate. The average growth rate for this time frame, which ends here, was 43.5%. Now, we invested in the company at a PE ratio of 42, which was slightly below the growth rate. So we're using Peter Lynch's P equals growth rate for very fast growing companies. Now, ironically, this stock had had a great track record. You could see that the price had gone from $2.28 in 1999 up to roughly almost $20 that we paid. We paid $19.85 to buy the stock. But a $10,000 investment in this stock would have really done quite well for you, or any amount of money invested in this stock would have done quite well. But after we bought the stock, it bounced around a little bit here, but I want you to notice that it started drifting as we came into the Great Recession, which is this gray shaded area. It really started to fall. And from the time we bought it to the second green dot here, where I'll cover in a moment, we actually saw the stock be cut in half. It fell 48.7% from that time frame. Now, at this point, it was a dog. Everybody hated it. What was I doing? And I actually ended up and bought more because as I was watching the company, I want you to notice that 2007's earnings growth, just as 2006 earnings growth, were both 48%. In 2008, they grew by 25%. In 2009, they grew by another 24%. So what I saw was this continuing advance in earnings. And so at this point, the stock was cut in half. I decided it was time to double up and add more. The advantage of that was I lowered my cost basis from $19 or $20 roughly to $15, but I bought some at 20 round numbers, and then I bought some more at 10 round numbers. Now, as time went on, I want you to notice the speed here. We start seeing, the stock price began to rally and it start moving back up towards the company's earnings growth rate. But now, I do want to show you something else here. The company's earnings growth rate had begun to slow down. So if I take some of the history off of the graph, we were now down to a 32% growth rate. But as I keep going forward here, this company is still growing at a very, very fast rate, as you can see here, if you look in this box here. And, ultimately, in the long run, after we had originally invested in this stock, and then once we had first purchased the stock, growth rate had slowed down, but now the stock had really begun to take off. The price of the stock had really begun to take off. And so, from our first purchase here, even though the stock I consider to be pretty undervalued now as a growth stock, which, by the way, now has started paying dividends, we would have averaged 11% a year on that original investment. But on the additional investment, we ended up averaging about 20% a year. If I measure this from our cost basis roughly, and this is about as close as I can get to it here, I'll be a little fair here. Well, that's as close as I can get. If I measure it from our cost basis to current, we've ended up averaging over 15% a year in this stock. And the point is, we could have sold the stock here anywhere during this period of time, and instead of making a lot of money for our clients over the long run, we'd have ended up losing a lot of money when we had a company that was doing extremely well. As long as the fundamentals are doing well, in my view, the worst time to sell a stock is when the price drops. You can look at, if you want to go to a more conservative dividend growth stock, we can look at something like Johnson & Johnson. And here's a case where the point is you could have bought this coming into the recession when J&J was fairly valued. The stock would have fallen like everything did during the Great Recession by about 20%, a lot better than most stocks did. But my point is that as long as you held on to the stock, you would have done well. Now, we actually did buy the stock during this Great Recession, if you will, right into the throes of the Great Recession at, as it turned out to be, almost a perfect bottom. But again, that was more luck than anything. We could buy Johnson & Johnson at under a 12 PE, and we've made a great deal of money holding this stock for a long period of time. But the point is, it was a better buy here than it was here. Just because the price drops doesn't mean, you know, you should sell the stock. In fact, it's probably the worst reason. But I also want to point out that not all price drops are the same. There's a big difference between a stock dropping from being fairly valued to becoming undervalued than it did if it dropped from being overvalued. For example, here you had an overvalued stock that dropped, but the point is it took years for the stock to get back to that overvalued level. But on the other hand, when you buy it at a undervalued level like here, the stock starts making you money almost immediately. Anyway, I hope you enjoyed this video. Worst time to sell a stock is if the price drops, as long as the fundamentals, the earnings and the dividends are continuing to do well. This has been Chuck Carnevale saying thanks for listening and watching. If you enjoyed this video, don't forget to subscribe to our YouTube channel. Thanks again.